underwriting is a skill. It's an art to learning how to input the numbers and how to evaluate these properties. If you would like to learn how to underwrite properties like this or properties like that, then come and join my coaching program. My contact information will be
All
below.
right, so it is 11 o'clock. Let's get started. Welcome to the Commercial Multifamily Masterminds. I'd like to welcome you all to our underwriting session today. And we have a guest today. And before I get into the guest, I would like to let Mark Gross just introduce himself. Tell everybody what you do, Mark, and how you work with us.
Sure. Thank you very much, Darryl. I'm with the CSSI. What we do are cost segregation and other tax studies, such as energy tax credits, Section 179D, research and development. We're the largest provider of cost segregation studies in the country. And for my information in the chat, if anybody would like a free preliminary analysis or analysis for any property nationwide. And if you're wondering what cost segregation is, if you happen to be a passive investor and you get K1s, most likely a lot of those losses are coming from the studies for cost segregation. And if you have any questions, let me know. Thanks, Charles.
All right, thank you. So now let's get into the crock of the story, right, of today. So it is my pleasure to introduce our esteemed guest for today's Commercial Multifamily Underwriting Show, Mr. Randy Smith. Randy is the founder of Impact Equity, a company dedicated to helping investors achieve outstanding results in their passive real estate investment strategies. Since its inception in June 2022, Impact Equity has successfully assisted over 100 investors in placing more than $8 million across 3 operators and 16 different opportunities. Randy brings a wealth of experience to our discussion, having transitioned from managing out-of-state single-family long-term rentals to becoming a seasoned expert in passive multifamily syndications. His impressive portfolio includes investments in 25 different passive opportunities with 11 different operators, giving him an unparalleled insight into identifying and capitalizing on strong passive investments. So in addition to his investments prowess, Randy has launched the RAISE, RAISE, Capital Coaching Consulting Program aimed at professionalizing capital raising efforts for other investors. Residing in Peoria, Arizona, with his wife Jenny, Randy combines his 25 years of experience in business development and leadership roles with his deep knowledge of real estate to provide invaluable guidance to our audience. So I'd like to just say welcome, Mr. Randy, to the Commercial Multifamily Mastermind Underwriting Show. How you doing today? So did I leave anything out? You want to add anything to that?
I think that was very thorough and very energetic. Thank you for the introduction. That was great.
Hey, no problem, no problem. Tell everybody just a little bit of, I know there's some things I still left out, but just I know you in Peoria. Were you already in Peoria? Tell everybody just a little bit more about yourself.
Yeah. So gosh, I'm trying to figure out where to fill in the blanks there. So I actually was raised in a small town in northern Michigan. I am a Youper, as they call it, living in the UP of Michigan. My parents owned a restaurant. My mom and my stepdad owned a restaurant where they put blood, sweat, and tears into that small business for 20 plus years, only to sell it for a loss. And then my dad actually worked for LA County Sheriff's Department, obviously in LA. So I kind of got the rich dad, poor dad situation working in my life, and I got to see what it looked like to be a small business owner grinding away, and then see what my dad did. Ultimately, he ended up owning 100 apartments in 100 apartment units in LA back in the 70s and 80s. So I got to see the impact of real estate on his life, and that's really what kind of drove me towards this as I hit. I guess I was in my mid 40s when I finally started investing in real estate.
Wow, that's good. That's good. That's excellent right there. I like that. I like that. So when um our platform here is about underwriting, the importance of it, why it's important. Um, what is your philosophy on underwriting? What is your theory on underwriting?
Yeah, so I think that's one of the most important questions right now. I think ultimately underwriting is a way to qualify or disqualify deals. I think it all comes down to the assumptions and what you're garbage in, garbage out. So if we're putting bad information in the tool, we're going to get bad information out. And I share the joke that I think there was this investor deck that went around that said, 5% cash on cash, 3 to 5 year business plan, 20% AAR, and double your money in 3 to 5 years with 15% IRR. I think that deck was sold really, really cheap somewhere because everybody bought it and started using it. And anybody can make an underwriting model show great returns based on the inputs that you're putting in it. So when I'm vetting deals, I dig into the assumptions, and I really like to question those assumptions. Where are the numbers coming from? Are they picking them out of experience? Are they picking them out of actual results? Or are they just pulling numbers that are going to make their models spit out the returns that they think their investors will need?
Okay, so the words you just said when I had asked you about being a guest on the show, and you said to me, you said, Darryl, you said, I love to be on the show, but underwriting is not one of my strengths. You said I'm good at doing due diligence on underwriting. When you said that, I was like, wait a minute, I definitely want him on the show because you said I do the due diligence on the underwriting. Now I know you mentioned a few things. I know. Can you dig deeper into what all of that due diligence what's entailed with that? I do my due diligence on the underwriting.
Sure. Yeah, absolutely. So it's a detailed process. Obviously, I feel like I've got like an 80-point checklist that I go through when I'm analyzing a deal, and I'll just kind of, start it. If you would like, I can kind of just start at the stop and run through some of those points, not all 80, of course, because this would be too long of a conversation. But I can certainly kind of dig into the ones that kind of jump out that I go
Yeah,
to at least initially.
yeah.
Um, and this might be a little bit different than the traditional due diligence or the underwriting analysis that a lot of people do. But starting off on the top, when I start looking at the sponsor, first and foremost, I need to have a relationship with the sponsor. What you find as a capital raiser after you start to have some success and you raise some capital, everybody and their brother wants you to start raising for them. And generally, people will reach out when they're in their final hours. They've gone to their network, and now they just need the final 2, 3, 500 million, 2 million at the end because they're not going to be able to close. So um, if somebody's reaching out to me and they're in that stage, it's almost always going to be a no, because 9 times out of 10 I don't know them, and I like to have a long standing relationship. personal track record with them as well. So do I know the sponsor well? Have I been referred to the sponsor is first and foremost on my list. So for those of you guys that are listening that might be in that same situation and thinking about reaching out to me, I'm probably going to say no unless we've known each other for quite some time. I like to dig into the next fact. Like, you hear a lot of people tout the fact that they're vertically integrated. And I think that can be great if your expertise is property management and construction management. If what I see a lot of times is people become vertically integrated, um, and they don't realize what they're getting into, and they end up finding out very, very quickly that property management is a thankless job, that there's very little profit in it, very, very thin margins, and it's not as easy as just saying you're a property management company. So a lot of people will tout that they're vertically integrated. So I like to dig into that and see, like, let's truly understand how effective you are, how long you've been doing it, how many doors do you have, what are the metrics you're using, those types of things. And this is something that's not shown in an underwriting model if somebody shares it. That can only happen by having kind of deep questions with them. Gosh, I feel like I probably need to move along because this is. Go ahead.
No, that's okay. This is excellent. But let me ask you a question, because there's two things that you mentioned that I do want to get into. One, that relationship with the sponsor. One, two, vertically integrated. Listen, a lot of us, we've been vertically integrated. What is this? What does that mean? When you say they say that they're vertically integrated, what are they integrated in? What are they integrated to? What is it that makes them vertically integrated?
Yes. So more often than not, what they're talking about is vertically integrated with property management and or construction management. So are they going to actually manage the day-to-day of the asset on, like, feet on the street, have a body in the property, handle all of the work orders that occur, collections, credit, analyzing new tenants, all of those things, or are they just asset managing? And then construction management, like, do they actually have in-house construction management personnel, or are they just 1099ing everybody and subbing out all the work? In theory, if you have a very strong operator that is very effective at both of those and they can control the results of both of those, then that is generally better than having a third-party property management or construction management. Because what I've found is, a passive investor, quite often the people that are using third-party property management, when things don't go well, they just want to blame property management. And for a while that makes sense, but at the end of the day, if you're the person choosing the third-party property management, ultimately, the buck stops with you. Yeah, it's amazing to me how often you hear people blaming third-party property management when ultimately they picked the third-party property management. So
Right. The one thing I say, and we've had to let go of two property managers. And after that, it was like, forget it. We're going to manage this thing ourselves, right?
yeah,
So the one thing I always say, you never really know a person until that saying, until you lay with them, right? That's when the dirt comes out.
yeah.
And with our property in Dayton, Texas, we had a property manager. We thought he was good. Yeah, we checked, but what could we say? We got into the
Right.
bed, boom, we had to let this guy go. He hit us up for some cash too when he left, right?
Yeah.
Second property manager. Now, between the first and the second property manager, we was managing that property for almost a year, close to a year. I think I left Texas because I was living there. I think I left Texas about 7th to 8th month. Came back home. We got a new property manager. That didn't work out either, right? Now we have felons running our properties. we had, yo, you got to go. So, but after all, we like, yo, forget about it. Let's just run it ourselves, because we could do a lot better job. and actually work. So when you mentioned about the bottom line is you said you picked them, right? Yeah, that's true. You are the one. And but when you find the problem, you need to step in
Yeah.
immediately to squash it.
Yeah.
And if you don't have a backup plan, you better figure out one real quick,
Yeah.
right? So I definitely like what you said in reference to that, because that's something that we have had to go through
Well,
ourselves.
and I think, Darryl, that's a really, really good point. Because whether you're managing these people internally or you're managing the manager,
Yeah,
exactly what you said, the ability to identify a problem quickly and make a decision to resolve that issue quickly. Ultimately, that's what we're looking for.
yeah,
So, third-party property management is not a bad thing if you can manage them well.
right.
And that's where like the true asset management comes into play. So
Good, true. That's absolutely. The Now I want to jump back to the relationship with the sponsor, because you said, hey, if I don't know you, I can't work with you, right?
yeah.
How much time and how deep do you look at that sponsor before you happen to put any investments with that sponsor?
Yeah, so I don't have a hard and fast rule on that. I used to have this rule that I would only put deals in front of my investors if I had invested with them and I had a long track record with them. Well, I at the time had only invested with 5 different operators, so that makes the pool very small. Um, so as my due diligence has actually improved, that window is really decreased. Um, and ultimately what it is as you mentioned, like you don't truly know somebody until they have gone through something difficult and you see how they respond in those difficult times, however that works. So my general rule of thumb is that I'll meet with somebody if I'm impressed with them. I'll ask to be included on their deal list and ask for some type of deliverable. Um, 9 times out of 10, I won't get the deliverable, and that immediately takes them off the list. Um, if they're if they're pursuing me and they can't follow up with the agreed upon promises from that first discussion, then it's usually an indication to me as to what the future relationship's going to look like. So I like to see expectations committed to and met repeatedly. And it could just simply be as simple as follow up with your investor presentation or some 2 or 3 questions that I ask that they follow through and follow up on. And then I like to watch for a while and see how they show up. The saying I always use is like anybody can show up great for a webinar or a presentation or an investor meeting, but do they do that consistently over time? And ideally, I'm actually referred to this operator by somebody that I know, like, and trust, and that will actually decrease that timeline even significantly more. So one is an example. I don't know if you guys know Ray Hightower or not, but
Yeah,
I'd consider a
yeah.
good friend of mine. He referred me to a group called Lone Star Capital, and I know, like, and trust Ray. And he made an intro to Lone Star Capital. And
Mm-hmm.
then within months, I was raising capital for them because they had met and exceeded all the other expectations. So if they can follow through on commitments and they get referred to me, then that's usually a much shorter window.
Right. Yeah. Yeah. Lone Star Capital been around a long time. Um,
Yeah,
that's what isn't
2019,
that what
2018.
yeah, this was Robert Beasley, right?
It is, yeah.
Yeah, yeah. I took I bought his book and studied his book and studied his underwriting model and stuff like that. Because I love underwriting. So, all right. So you said the deliverable. You asked them to bring you the deliverable, and if and few times they haven't done it. That's a red flag, right? But what is the deliverable that you requested?
Yeah, it depends on how the conversation goes. I mean, ultimately, I need to see an investor deck. Um, if I'm coming down to the finish line with folks and I'm doing the due diligence, I like to see the either the most recent updates
Okay.
for all of their current assets, So if they're doing monthly updates, I'd like to see the last 2 monthly updates for all of their current portfolio. And like part of that due diligence process is, how is your current portfolio performing? Are you meeting or exceeding expectations? What kind of problems are you running into? And then after you have that conversation with them, asking for those recent updates that they've shared with their investors, it's pretty telling. So does the story match what they told you, right?
Right.
First and foremost, do they even have monthly updates or quarterly updates that they're doing with their investors? Because surprisingly, a lot of people don't. And seeing actually when those are dated, even I'm like super analytical and want to look at those details. Like, are they sending it out on the 3rd of the month every month, or is it the 3rd and the 15th? And is there really no cadence to it? Because investors like predictability, and they, if they're expecting distributions on a certain day, when does that happen? So those types of things. There's a lot of discussion around distributions. When are they occurring? Are they consistent? Have they paused distributions? Just because they've paused distributions doesn't mean that that's a bad thing, because I think a lot of people don't pause distributions out of fear of what that's going to mean to the investors, when in fact they should actually be pausing distributions because there's not enough money in the coffers to take care of the property. So that whole story is really important. I even had one situation where an operator had lost some investor capital, but when we got into the story and understood what exactly happened there, it made sense. And I won't share all the details about it, but ultimately, when you have certain partners that are working together and one makes a decision to do something and the other doesn't want to do it, at some point, something has to break. So there are times when things happen with assets that are unpredictable and unresolvable without something else happening. So I like to dig into all of those things. And you guys might be getting the sense that I'm probably a kind of a pain in the butt to work with as a capital raising partner. But I would rather be a pain in the butt on the front end and not have any surprises than not be a pain in the butt and be surprised and have my investors surprised on the back end as well. So
Gotcha. Okay. Now, you mentioned about predictability. There's a lot that's going on in today's economy. A lot of properties. I'm not going to say a lot of properties, but properties have been falling through, or as we say, have been turned back into the bank. Here's the keys. Blah blah blah. Interest rates up and down. I think they're starting to flex out a little bit or relax a little bit. But with today's economy being the way it is, have you had to adjust any of your criteria since the economy is not stable? So, have you had to change anything? Maybe relax a little bit on one thing that you may have been hardcore on. So, can you speak on that?
yeah, I think investor return expectations are evolving. Um, and early on, I think let's see here. I mean, the reality of what I'm seeing today is the deals that are actually getting done have better um, returns than what we saw even just a couple of years ago.
Right.
That's just simply a function of, if deals are actually happening, they're happening at prices that people are much more conservative. The debt obviously is much higher. So if a deal will work today, it's going to look really, really good in a couple of years when interest rates come back down and things start to stabilize a little bit. So has investor expectation kind of matched what the market is? I don't know. It depends on the sophistication level of the investor. People that are sophisticated understand what's going on in the marketplace and understand that there has to be some concessions with those. But the traditional retail investor that is primarily a stock investor, their stock portfolio is blowing up right now. So they are wanting to see better returns for the amount of risk that they are accepting in this space. And like I added a debt fund earlier this year, thinking that that was going to capture those high yield savings account people or those people that are keeping money in the money market. But when you see the stock market at almost 20% year to date, you know, an 8% return doesn't look all that attractive. So certainly the sentiment of the investors is fluctuating just like it is, just like the market is. And I think as things start to stabilize, we'll start to get some more realistic expectations from our investors again as well. But reality is capital raising is hard today.
Exactly.
Harder, you know, harder than, well, I've only been capital raising for 2 years. And they said when I started, it was hard, but it's just got steadily harder and harder over the last 2 years. So,
Okay. When you ask for certain documents, and I do have another question about that 8%, but I'm gonna ask that question later.
sure.
When you ask for certain documents, deliverables, or do you take a look at the T12? Do you take a look at the rent roll just to see if there's any inconsistencies? Do you look at any of those documents doing your due diligence?
Yeah, so I will look at T12 compared to year one.
Okay.
And so I won't actually I won't go line for line T12 to their underwriting model. I will look at the underwriting model, which shows the T12 generally, and compare that to year one. And I like to see, you know, if there's big variations between T12 and year one, I want to understand why those variations exist. I think at times you'll see operators come in and they will assume that they can perform at a better level than what the current operator is that's owned it for many, many years. And
Right.
I've seen too many times where they make those assumptions and then they find out something that was unknown, and you know the expenses are the way the expenses are for a very valid reason. So I think it's important to just understand the fluctuations, and then also the year over year. Like if you're looking at rent growth and expense growth, if there's a big gap there, if you're seeing rent growth of, you know, anything more than 3%, I really start asking questions. Honestly, if it's flat in year one, I would prefer to see that. If you see expenses are, you know, 1.5% year over year, but rent is 3%, like what makes you think that expenses are going to grow at a certain level and your rent's going to grow at a higher level? So, and I think 9 times out of 10, just having those conversations can help you get in the mindset of what's going on in this underwriter's mind, and you know, see if you're in alignment with him or not.
Yeah. Yeah. With the expenses, 'cause let's say you saw like a 1.5. No, let me back up. So inflation right now, I do believe is around about 3.2 or 3.1, somewhere around in that area.
Sure.
So if you're looking at a T12 and or the underwrite, you're looking at the underwrite and you see that their expense is way less than inflation, would you question that?
Yeah. Yeah. Ultimately, yes. So, and
Gotcha.
especially when you start looking at taxes and interest these days, like it's or insurance. Yeah, we'd all hope to see insurance starting to come down, and I think we saw a blip there. But yeah, everything that I'm hearing is saying that insurance could still be increasing at a similar path as to what we've seen over the last few years. So I think those are important things, and digging into those assumptions as well, like where do people get their tax assumptions and where do they get their insurance assumptions? Like, are they getting quotes? Do they have master agreements on their insurance? Those types of things. Do they truly understand how the taxes are being equated in their municipality? Like that's critical information.
You normally do you have your own I'm gonna say applications, like maybe maybe CoStar, Crexy, or some other application? Do you have any of those things that you may happen to go to for a reference or a referral to see what's going on in that particular market?
So it's funny you bring that up. I worked with somebody at American Express for 10 years, and she just became I think, vice president of business development for CoStar. So I am getting reports from her, but I don't have a subscription. Um, and that's something new, but no, up to this point, I've not had that. I don't have the resources to pay. Those are
Okay.
extremely expensive subscriptions, but I do the silly things like I'll get on Google Maps and look at apartments.com and actually look at real rent comps and try to understand, like, if they're excluding certain properties for some reason on their rent comps or sales comps, um, like, why are they excluding them? Because that can be a big piece in the assumptions as well. In fact, on a deal I just recently walked away from, there was a comp literally across the street that was the same year for rents, and they were ignoring those rent comps. And had they included those, their assumptions would be very different on their expected rent. So, and I think it's important for operators to know that investors are looking at that stuff. So if you're skipping that, there's going to be a percentage of the population of your investors that are looking at that stuff as well.
Right.
And essentially, once you lose integrity with an investor, it's gone.
Right.
Yeah, it's very hard to build back at that point. So,
being a passive investor, I would say there's a lot of fortune, like a lot of new passive investors. I think that want to get into investing in commercial multifamily or commercial itself. What would you say? Thought I heard something in the background. I had to try to clear it up. I didn't
no
want it
worries.
to echo in. Um, but for passive investors um, that's getting into the commercial space, they're wanting to invest passively, not as a general partner. Okay, would you say to them, at least learn the basic foundation of underwriting, what's in it, and where the data come from?
Yeah, I think ultimately it comes, as I said at the very beginning, like, it comes down to the assumptions. Unfortunately, the underwriting models can be a little overwhelming for even an experienced investor. So I think it comes down to those inputs that are going into it, and understanding what those are and what they mean. So, as I've spent more and more time in this space, like, I'm starting to spend more time with economic trends to really understand, because ultimately, no matter how good or bad you are, economic trends have probably the biggest impact on these assets than anything. Um, so, like, understanding those become more and more important. But yeah, it's if you were to create like a to-do list or a task list for a new passive investor, like, I joke with people and say, go up to Google and do just a simple search, like top 100 questions to ask a multifamily syndicator if you're considering investing, and that will be a pretty good start. I think more importantly than that, though, it's like you get a lot of investors that come in and they'll throw big checks at deals right away, and then 6 months from now or a year from now, they're wishing they'd invested less and diversified more. So that's really my mantra, is like, if you're bringing a couple $100,000 to the space, like, spread it across a few deals, spread it across a few operators, spread it across a few different asset classes, because you really don't, like, as a new passive investor, you don't know what's going on.
Right.
You can only get educated to a certain degree. And when I look back at my first passive investment, I would never make that investment today. Actually, probably the first three that I did, I would never do those today. And I put way too much money in those first deal investments. So today, I write smaller checks and more of them, and I diversify like crazy is what I do. So.
See what happened. That comes with experience. over time,
Exactly.
right?
Exactly. Yeah. Yep.
Experience over time. You know,
Well, and
human.
it's hard as a capital raiser too. Like people will come to me and I tell them to split them up. Like, of course, I want their $200,000 checks for my investment, but is that really the right thing for them? Um, you know, I'm confident that every deal I put in front of my investors is going to be a great deal, but they're not. I mean, the reality is all deals are not created the same. So
Right,
at some point, you're going to have a loser. So
right. So you would, so if I came to you with 200,000, you would say to me, Darryl, split this up to like
I
put
would.
50 here, 50 here, 50. Now, would you have the deals so that I could split that up into them different things?
I have 3 deals today. So I always have. I have 2 evergreen deals,
Right.
and then I always have 1 multifamily. So, but I've done 16 deals in the last 2 years, so I'm going to have another deal in 45 days. I'm
Okay.
never more than 45 days away from another deal.
Wow. I like the way you think. I
Yeah.
like the way you think. I like that right there. Yeah.
When it's important too, I think for operators, and this is kind of going off a little bit of subject, but 9 times out of 10 with investors, it comes down like when they have money they want to place, they're going to
Mhm.
place that money within a small window. And if you don't have a deal, it's going to somebody else. Um, so part of my strategy has been to put deals consistently in front of my investors. So when they have the capital, like it increases
Mhm.
likelihood. And I think even for operators that might only do 1 or 2 deals a year, I think it makes sense for operators to consider raising dollars for other operators, just to satisfy the deal flow needs that your investors have. Because would you rather get a portion of the potential earnings on a deal, even if you're not operating it? Would you rather get a portion of that by raising for somebody else, or would you rather it just go on to somebody else? And um, at the end of the day, they're gonna find a place to put that capital if you're 3 months or
Right.
6 months away from having another deal.
That's interesting. I like that. I like that whole thing, that whole theory right there, what you just said. Um, let's say, let's say we didn't have IRR. We didn't have equity multiple. We didn't have average cash on cash. We didn't have MPV. Let's say we didn't have that, but we were investors. What would you look for in a deal? But we don't have, remember now, we don't have IRR. We don't have equity multiple. We don't have cash on cash. Those numbers are don't even exist. We don't know nothing about those numbers.
Okay,
We don't know nothing about MPV. But
sure.
here's a underwrite. Here's a profit and loss statement that was underwritten by a T12 and everything. You have the performer. What would you look for on that performer that you would say I would invest in this deal?
So can we talk about NOI?
Sure.
Okay,
Because
okay,
yeah, because
so
NOI is going to be there. Because you have to have
okay.
the NOI. You got to have that. NOI is going to
I
be
was
there.
I wasn't sure in this make-believe
Yeah.
world without metrics if we had NOI or not. So yeah, I mean ultimately these are businesses at the end of the day.
Correct.
So is it a profitable business? Yes or no? If so, is there a business plan in place that is going to increase the profitability of that business or not? And if there is, and they've got a track record of doing what they say that they're going to do on this one, then
Right.
it makes sense. I mean, at the end of the day, um, NOI increasing is is the end all and be all. And I heard somebody once say that it's the only business in the world that you can take a $50 can of paint and go paint stripes on a parking lot and say reserved and increase the value of an asset by $500,000 in an afternoon. Like it's the most powerful business mechanism in the world. So if you can find ways to drive NOI very efficiently and effectively, you're going to drive
Mhm.
profitability and returns to your investors.
Okay. So now I'm going to throw another line in. So we got the NOI. we have the debt service. You got your cash flow. So we still don't have the IR. We don't know nothing about IR that haven't even been created. We know nothing about equity multiples that haven't been created. We know nothing about ACOC that ain't nothing that have never been created. But we, like you said, we got the NOI, we got the debt service because you went and got the loan, so you got to pay that back. And now we got the what's remaining, the cash flow. When you look at your cash flow, is there, since we don't have the rest of those metrics, is there, I guess I could say, a minimum amount of cash flow that you want to see on that and that performance?
So I like to see DSCRs that are obviously 1 plus, closer to 1.25, and the path trending where that's getting larger ultimately. So DSCR is another metric I watch really, really closely. Yeah.
All right. So, okay. So now we know that the DSCR, the property is cash flowing. I like that. Okay. I asked that question because a lot of times I feel like we get caught up on the outside things, other things. What's going on, what's the market cap rate? What's this, what's that? And you have a deal, it is cash flowing, but some I'm gonna say operators, they're looking for that specific dollar amount in that cash flow.
Yep.
And if it doesn't hit that specific dollar amount, do you want the deal or are you going to let it go? Now, and it's still cash flowing, but it just may not hit it may be $1 short, but you say, nope, I don't want it.
Yep.
So that was the reason why I asked that question. A lot of times we get caught up in the IRR. Oh, what is this IRR? What is equity multiple? And I think some people don't really know what IRR really represents.
And I think it's a really good point because we're training our investors on what to expect by the information that we're putting out there over and over again. And I interviewed, there's a lot of people out there that just play a flat 10%. Like that's it. They don't talk about IRR. They don't talk about equity multiples, nothing. They're just flat 10%. There's plenty of operators out there that are just doing 6%. During the whole period, an extra 6% when we sell it. Like literally, that's all they're paying their investors because they've taught their investors that that's what they're going to get. I asked one operator like why he chose that model. He said, "Well, because I can and I make more money." And I'm like, "Well, that the market's looking for this." He's like, "My market's not looking for this. My investors only want 6 and 6." So when you're going through deals, like there is an avatar that is looking for different type of metrics than what you've been preaching over the last 5 or 10 years. So it's just a matter of finding those. And what I found is like with my diversification I share with my investors is I have different return risk profiles and different metrics that each of my short-term rental has higher cash on cash, but it's going to be a lower equity multiple in the long, and it's going to be a longer hold. My multifamily, I'm in this space. My debt fund is just flat 8.25%. That's it, but it's liquid day one. You can get your money back anytime you want. And there are not only people like when you think about your investors, they're managing their portfolio. Most of them are not 100% in multifamily value add. They've got some in the stock market. They've got some in money markets. They've got some in all these other areas. So if you're just talking to them about one little piece of their bucket's much bigger than that. And they've got an appetite for other offerings as well. If you can match those needs on the risk return of those other buckets in the portfolio.
I like that. Our business, commercial multifamily has gone through a lot of changes. And now with the economy the way that it is, I think that Have you seen returns drop a little bit, where instead of being able to get an 8, 7, maybe they got a 7 or a 6 over a 5 to 7 year period?
What metric are you talking about? 876 prefs or
Cash on cash.
um so cash on cash is more dictated by the business model and
Hmm.
the debt
Hmm.
structure than anything, right? So, I've got some operators that I work with that do tax abatement, which is almost 7% year one. Um, if you're multifamily value add in the Midwest, you're going to be in the, 7 to 8% cash on cash year one. You're going to have lower appreciation in those markets, and you're going to probably have lower appreciation on the tax abatement too. Um, so it depends. Cash on cash. The reality is that operators have their metrics they're trying to hit, and if they can't hit their metrics, they don't do the deals, right?
Correct.
So maybe those are adjusting slightly, but we're just seeing much less deal flow. This deal that I just did in Jacksonville, it's a loan assumption. And we've got, I mean, it's probably the most conservative underwriting I've seen, and it's a 2.4 equity multiple on the back end. And I didn't even advertise a 2.4 because I thought people would think, well, that's outlandish to get a 2.4 equity multiple. But it's 6.6% cash on cash year one
Wow.
because of the loan assumption, you know?
Yeah.
So,
I've been doing a lot of underwriting for loan assumptions, but some of these numbers are just not panning out. Um,
yeah.
where they may be asking 11.5 million, and even with my loan assumption, um, I'm only coming in at 7 million. So I'm just wondering what's still going on in the market um, with some of these deals. Just wondering.
Well, and I think that what's going on is you've got operators that have investors in their deals, and they've got to sell it for that 11 million. Otherwise, they're losing investor capital.
Correct.
And if the bank's willing to kick the can down the road another year or so, they absolutely should kick the can unless they can sell the thing. Um, so at some point though, all of these people are going to have, I mean, the bank will ultimately end up forcing these people to sell at some point
Right.
if they don't see things trending in the right direction. So,
Yeah, I agree. Uh, Alicia, my co-host, you have any questions?
It's great to see you, Randy, my
good to see you as
fellow
well.
Arizonian. When you are raising capital, how do you keep your investors engaged in that
That's $1 million
process?
question, isn't it? Yeah. So are you saying engaged like with a particular offering or just over
With,
time?
with that specific offering until it closes.
Yeah. So generally I do weekly updates when I launch a deal. Um, you'll see a lot of, 50, 70, 80% subscribed. Um, nothing special am I doing here than anybody else. A lot of people will do, like I hear people that'll do an email update every single day the first week, and then they go to every 3 days, then they go to, and I just don't want to blow up my investors inbox. It's probably a limiting belief that I have. Um, but I know if I'm getting daily emails from people, I'm unsubscribing. So
Yeah.
yeah. So at the end of the day, and that could just be, like I said, that could be a limiting belief that I have. That's a fear of losing investors that we work so very hard to get into the funnel. Um, and maybe I could do better by emailing more, but at this point, I just do weekly updates on those. And then I'll do a close announcement and a congratulations to our investors announcement and that type of thing.
That's awesome. So have you ever had a situation where the investment that you've underwritten has changed in numbers before you closed? And if so, how did you deal with that in the communication with the investors?
Yeah. So I think the key there is communication. So I had one deal that we had under contract at the early part of last year. Um, And I launched to my, actually, it was like February. I launched to my investors in March with an initial close of like June 1. And that deal did not close until October. And it was a tax abatement offering in Texas. And I was able to negotiate that we would start paying pref at the initial closing date, even though it got pushed back, and gave my investors the ability to get their money back. Had one investor ask for his money back, and we gave it to him. But everybody else, like, I think if you just communicate regularly and share with them what's going on, more often than not, the hurdle is the wire. And once you get the wire, if you communicate well, I think you can hold on to those dollars. So, and we all know at the end of the day, like nothing is 100% underwritten accurately. Nothing's going to turn out exactly as we underwrite it. And I think it's important to share that with investors as well. Like these are all guidelines. If everything goes perfectly, this is going to be what's going to happen. But inevitably, it's going to be above or below this. We're going to sell in, I say 3 to 5 years is what I say now, usually even on a 5-year pro forma. So yeah, I think communication is key.
That's awesome. With the investor that asked for his funds back, did you just over raise so you were able to replace those funds?
So we hadn't closed yet. So the money was
You
just
haven't.
sitting in the fund.
Got it. Okay.
Yeah, so the dollars were there. I was actually, this was a co-GP that I was doing at the time. So I didn't even know if I could return it. But when I reached out to the operator, they said that we could, and we did. And again, I think it was 25 grand. So it wasn't going to make or break the deal anyways.
Right.
Yeah.
That's awesome. So those are the questions that I have there. You're
Awesome.
pretty thorough.
Well, thank you, Miss Alicia. Thank you.
Yeah.
But Randy, you mentioned something. Alicia asked you a question about the capital being given back because you hadn't closed, right?
Sure.
So let's just so that new investors are clear who's getting into capital raising, who have and they've never done it before. Let's make it clear to them. Most likely, before you close, you could give that money back. But once you close, what what document should they read before they say yes or no to that investor?
The PPM ultimately,
There
right?
you
That's going to dictate whether you can or you can't. Yep.
There it is.
Because if you do
yeah,
allow one investor to get their money back, you have to allow everybody to, right? You have to have equal treatment across all investors. So
right. Normally, once you close, have you ever had to get back money after? No.
no. But I think that's a good point. Like early on when I was raising capital, I was essentially taking money from anybody that would give me money. And I was doing the very best to share all of the risk and all that stuff. And they signed the paperwork, so we're protected and all of that. But now, and maybe to my fault, I make sure that I cover 5 things with everybody. Like one, like I want them to understand this is illiquid. You are not getting your money back. If the car breaks down or your roof gets blown off, we can't give you the money back. 2, this is passive. You don't have voting rights. You don't have control. You don't get to say when we sell or refinance. 3, like I never want to take anybody's last 25 or $50,000. Like the joke is I don't want to become a bad name in anybody's household that Randy won't give us our money back. K1s can and quite often are late. So if you're waiting for your $7,000 tax return so you can feed your kids, this is not the investment for you, right? And then lastly, it is possible we could lose all your money. Like that does happen. So well, I might be scaring some people away by saying those things. I am scaring away the people that probably have no business being in the space in the first place. So,
and that's true. That's true. So, I just want to say, Randy, I appreciate you coming on the commercial multifamily masterminds. It's the underwriting platform, the underwriting show, and because this is the direction that that we go into. We talk about underwriting because underwriting is very, very, very important. And I'm
I agree.
glad that you spoke about it from that from a passive investor point of view, but also as a capital raiser point of view, right? You
Sure.
spoke about it to explain that. So, what parting words would you say to a brand new investor that's getting into this game and they're going to be raising money? What parting words would you say to them?
Yeah, so if I were talking to a capital raiser, I would say first and foremost, you need to invest yourself in this space. You need to understand what you're asking your investors to do. And the only true way to do that is to put some of your own money at risk. And not only will you learn a lot, but you will build credibility. And if you've done a good job on the due diligence, you're going to get great returns on your money too. So um, invest first and then spend some time in these underwriting discussions because I guarantee you don't even know what questions to ask until you spend some time with folks like Darryl and Alicia, because this is this and debt. These are the two things that are going to impact that deal more than anything. So,
All right. Randy, thank you very much for coming to the Commercial Multifamily Masterminds, the underwriting show. I really appreciate your time. If anybody wants to get in contact with you, wait a minute, you have you also have a coaching program, right?
I do. Yeah. So I am actually just in the last couple of months, I started coaching new capital raisers or existing operators that are trying to professionalize their capital raising and take their capital raising to the next level.
Right.
And I've got a 5-part coaching program where we cover avatar development and story development. We cover LinkedIn automation. We cover identifying the best operators in that due diligence process, that 80-point checklist, how to structure your fund or what type of business structure will work best for you. And then last, how to engage through CRM, investor portals, and email marketing. And what I found is of the 8 new clients I brought onto this, 4 of which had gone through the program and kept me on as a consultant, essentially adding me as a fractional investor relations person to help them with their businesses. So it's been a lot of fun, and I'm doing more and more of it. So
Fantastic. Well, make sure you put your contact information in the chat. I think you did, but make sure
I did.
that you put that there because I want to make sure that everyone have it. And I'm gonna have to bring you back. I'm gonna have to bring you back and
I would love
to
to.
talk to you some more because man, you gave out. I always say, everybody talking about they give out gold nuggets. Man, you was dropping bombs.
Well, thank you. Yeah,
You was
hopefully I brought some
dropping
value.
bombs, platinum bombs, and everything blowing up.
Love
So,
it.
but I hope that everyone got something out of this because underwriting is important. You may have that ability to capital raise, but if you don't know how to underwrite, I guarantee you, Randy ain't giving you no money.
That's for sure.
All right.
That is
So,
for sure.
so you best to get to learning how to underwrite. Come on to my coaching program. Let me help you with the underwriting. Let's get you started. And then we're going to run right over to Randy to get the money. All right. All right.
Absolutely. Absolutely. Reach out.
Thank you. Thank you very much, Randy, for coming and for being here. And I want to thank everyone else for coming and for being here. And I'll see everyone else on July 23rd because we meet other every other Tuesday. So I'll see you back here July 23rd, 11 o'clock Eastern Standard Time on the Commercial Multifamily Masterminds Underwriting Show. Thank you all for coming.